Good morning, everyone. I will begin with the first accounting issue, which is revenue recognition under MFRS 15. The issue in this case is that NTK Corporation Berhad recognized revenue immediately after delivering goods to Omega Trading Berhad. However, according to the agreement, Omega is only required to make payment after the goods have been sold to the end customer. This creates an accounting issue because the arrangement appears to be a consignment arrangement rather than a normal sales transaction. In a consignment arrangement, the supplier still retains control of the goods until they are sold to the final customers. Therefore, recognizing revenue immediately may result in premature revenue recognition. For the analysis, according to MFRS 15, revenue should only be recognized when the entity has satisfied its performance obligation by transferring control of the goods to the customer. In this case, although the goods have been physically delivered, Omega has not yet obtained full control because payment depends on future sales. Management must exercise professional judgment by reviewing the contractual terms and determine whether control has actually transferred. Since NTK still bears significant risk associated with the goods, recognizing revenue immediately doesn't comply with MFRS 15. The appropriate accounting treatment is for NTK to defer revenue recognition until control has been transferred to Omega or when the goods are sold to the end customers. Until then, the goods should remain as inventory and no revenue should be recognized. This ensures that the financial statement fairly reflect the company's actual financial performance. Next, I will explain the second accounting issue, which involves the revision of the useful life of property, plant, and equipment. In this case, Ahmad revised the useful life of several high-value manufacturing assets without obtaining any technical assessment or supporting evidence. The purpose of this revision appears to be reducing depreciation expense so that the company can report a higher profit. For the analysis, according to MFRS 116, the useful life of an asset should be reviewed regularly, but any revision must be supported by reliable evidence such as technical reports, maintenance records, or expert assessment. In addition, MFRS 108 explains that changing the useful life of an asset is considered a change in accounting estimate, not a change in accounting policy. Therefore, any revision must be based on new and reliable information and should be applied prospectively. This means that management cannot simply change the useful life to achieve a desired profit. Instead, they must use professional judgment and make reasonable accounting estimates supported by objective evidence. Therefore, the appropriate accounting treatment is to maintain the original useful life unless there is sufficient evidence to justify the revision. If there is reliable evidence, the revised useful life should be accounted for prospectively in accordance with MFRS 108. This ensures that depreciation expense and the carrying amount of the asset are fairly presented in the financial statements.
So, the third issue is about earning per share or EPS. NTK issued convertible debt to finance an investment project but only disclosed basic EPS in its financial statements. The company did not disclose dilute EPS even though the convertible debt can be converted into ordinary shares. This may give investors an incomplete picture of the company's actual earning performance. Alright, so for the analysis, according to MFRS 133, a company with potential ordinary shares, such as convertible debt, must disclose both basic EPS and dilute EPS. Dilute EPS shows the possible impact on earnings if the convertible debt is converted into ordinary shares. Therefore, management needs to assess whether the convertible debt is dilutive based on its terms and conditions. By not reporting dilute EPS, NTK's financial statements become less transparent and provide less useful information to investors. So the treatment to compile with MFRS 133, NTK should calculate and disclose both basic EPS and dilute EPS in its financial statements. The company should also include the relevant information about the convertible debt in the notes to the financial statement. This provides users with complete and transparent information, allowing them to better understand the company's actual earnings performance. So for the fourth issue, which is last issue, involves Alpha Tech Berhad, which is NTK's biggest customer. Alpha Tech was declared bankrupt before the financial statements were authorized for issue. However, Ahmad instructed Alia not to disclose or assess the impact of this event. This is an important accounting issue because the bankruptcy may provide evidence of conditions that already existed at the reporting date. Alright, so for the analysis, according to MFRS 110, events that happen after the reporting period must be assessed to determine whether they are adjusting or non adjusting events. In this case, management should evaluate whether Alpha Tech was already facing financial difficulties before the reporting date. If there is sufficient evidence that the financial problem already existed, then the bankruptcy should be treated as an adjusting event. Therefore, management must be professional judgment and consider all available evidence before the financial statements are approved. So for the treatment, to comply with MFRS 110, NTK should assess whether Alpha Tech's bankruptcy is an adjusting event. If the financial difficulties existed before the reporting date, the company should adjust the relevant balance in the financial statement. However, if it is considered as a non-adjusting event, the company should disclose the bankruptcy in the notes to the financial statement. This ensures the financial statements provide reliable information and avoid overstating the company's asset or profit.
Next, I will explain about ethical issues arising from the financial reporting decision made by the director Ahmad. Under the observation stage, Ahmad instructed the accounting to recognize revenue early, change the useful life of the asset without proper justification, disclose only the current EPS, and omit the bankruptcy of Alphatech from the financial statement. This decision resulted in misleading financial statement. 14. Ahmad made this decision because he wanted to maintain the debt to equity ratio below than 50%, improve EPS, and attract investors. He prioritized the company's financial target over ethical reporting. Besides, for understand, Ahmad should understand that this accounting treatment must comply with MFRS 50, MFRS 160, and MFRS 110 to ensure the financial statements are reliable and present a true and fair. For remember, Ahmad should remember that as a director, he is responsible for ensuring the financial statements are prepared honestly, ethically, and according with professional standard. Next is reflect. Ahmad should reflect on impact of his decision on stakeholder and recognize the importance of ethical financial reporting. Lastly, for remorse, moving on to the ethical dilemma faced by Alia, under Niyat, Alia intends to carry out her duties professionally by following accounting standard and ethical principles. Next, under Itia, Alia should make every effort to prepare truthful financial statement even though she was under pressure from Ahmad. For Amanah, Alia has responsibility to record all transactions accurately and ensure the financial statement information is reliable. Under Muraqabah, Alia should continuously reflect on her action and ensure they comply with professional ethics, integrity, and objectivity. Finally, under Natijah, following Ahmad's unethical instruction could result in misleading financial statement, damage the company reputation, and affect Alia's professional career. Next, we will explain the evidence of management pressure, incentive, and performance targets in this case. Firstly, Ahmad experienced pressure because he wanted Alia to follow his instructions even though the accounting treatment were inappropriate. Secondly, Ahmad had incentive to manipulate the financial statements because he wanted to attract investors and increase employee compensation. Lastly, Ahmad aimed to maintain the company's debt to equity ratio below 50% and report higher EPS to achieve the company's performance targets. These pressures and incentives created a risk of unethical financial reporting decisions.
This situation also shows a conflict between compliance and instructions. Ahmad prioritized achieving the company's financial objective instead of ensuring compliance with MFRS. He instructed Alia to make accounting adjustments that may not reflect the actual financial position of the company. On the other hand, Alia experienced an ethical conflict between obeying her director's instructions and fulfilling her professional responsibility as an accountant. As an accountant, Alia should always comply with accounting standards and professional ethics to ensure the financial statements provide reliable information.
Lastly, I will explain about evaluation of action based on AADAB, which is ethical conduct, integrity, and accountability. Firstly, Ahmad failed to demonstrate ethical conduct because he manipulated the financial statement to meet the loan covenant, attract investors, and improve the company's financial performance instead of following MFRS. Secondly, for integrity, both Ahmad and Alia should have upheld integrity by ensuring the financial statement present a true and fair view. However, Ahmad's instruction and Alia's compliance could mislead stakeholders and reduce the credibility of the financial report. Lastly, Ahmad as a director and Alia as an accountant are both accountable for ensuring that financial statements are accurate and comply with accounting standards to maintain stakeholder trust.
I will present the recommendation for issue number one, which is recognition issue involving the sales to Omega Training Berhad. So the first, Ahmad should recognize revenue only when all the MFRS 15 criteria are met. So since payment depends on Omega selling, the goods to customer, the revenue should not be recognized too early. So Allah should also maintain her professional integrity by questioning the instruction and discussing it with senior management. So for the second, NTK should strengthen its internal control by requiring senior financial approval for major sales transaction. Also, conducting regular internal audits and provide a whistleblowing channel for employee to report unethical practices. So the third, the company should provide regular training on MFRS 15, the MIA Code of Ethics, and ADAB principle. So this will help employees make ethical decisions and ensure financial reporting is honest, transparent, and compliant. So next, I will present the recommendation for issue number two, which is the revision of useful life without proper assessment under MFRS 116. So first, Ahmad should only revise the useful life of asset based on sufficient technically evidence and professional assessment. So Alia should also request supporting document and avoid processing unsupported estimate that could mislead user of the financial statement. So the second, NTK should improve its internal control by requiring qualified engineer or technical specialist to review asset useful life before management approve any changes. So the audit committee should also review significant account estimate. So finally, the company should strengthen professionally integrity by providing regular ethics training and reminding employee that accounting estimate must be used on objective, evident, not a management desired financial result. So this recommendation will help ensure that accounting estimate are accurate, reliable, and comply with MFRS 116. So the recommendation for issue number three, which is the failure to disclose the issuance of convertible debt to fund a new project. So first, NTK should fully disclose all required information under MFRS 133, including both basic and diluted EPS. So, ILA should also ensure all mandatory disclosure are included and raise any concern if important information is omitted. So, second, the company should strengthen its internal control by using a financial statement disclosure checklist and requiring all disclosure to be reviewed. So, senior finance personnel and the audit committee before the financial statement are issued. So finally, the finance team should attend regular technical training on complex financial instrument and disclosure requirement. This will help ensure financial report are complete, accurate, and comply with accounting standard. So this recommendation will improve transparency, strengthen compliance, and build greater trust among investors. So the last issue is the exclusion of Alphatech bankruptcy information from the financial statement. So first, NTK should disclose Alphatech bankruptcy and recognize any impairment loss if required under MFRS 1110 and MFRS 9. Alia should also uphold her professional responsibility by reporting the issue if management refuse to make required disclosure. So second, the company should improve its internal control by introducing a formal year-end review process for subsequent event. The audit committee should also review all material event before the financial statement are approved. So the last, regular training on MFRS 1110 and ethical reporting should be provided to strengthen transparency, honesty, and accountability to ensuring the financial statement reflect the company true financial position. So this recommendation will improve transparency, ensure compliance with accounting standard, and increase stakeholder confidence. So first, how can they prevent recurrence of similar ethical and reporting issue? So the recommendation have prevent similar ethical issue by introducing stronger review procedure and requiring accounting decision to be supported by sufficient evidence rather than management preference. So when significant accounting treatments are reviewed, the finance department, technical expert, and the audit committee, the risk of financial statement manipulation can be reduced. So the second, how they ensure continuing compliance with accounting standard. So compliance is strengthened through regular training on MFRS, the use of accounting checklist, mandatory supporting the documentation, and independent review before financial statement are issued. So there's a control help ensure that revenue recognition, accounting estimate, subsequent event, and EPS disclosure comply with MFRS 15, MFRS 116, MFRS 108, MFRS 1110, MFRS 9, and MFRS 133. Number three, how they promote ethical financial reporting practices. So, by promoting professional integrity, encourage account to prioritize honesty, objectivity, and transparency when preparing financial statement. So this is help build trust among investor, lenders, regulators, and stakeholder because the financial information present is complete, reliable, and free from intentation. intentional bias. So number four is how they contribute to a sustainable and responsible corporate reporting culture. So it will contribute to a sustainable corporate reporting culture by strengthening accountability, uh, also improving governance and encourage ethical decision making throughout the organization. So a company that consistently follows accounting standard and ethical principle is more likely to maintain stakeholder confidence, protect its corporate reputation, and achieve a long-term business sustainability.